$1 invested in this company in 1968 was worth $6,638 in 2015, including dividends. That's an annual return of 20.6% per year for nearly half a century. No other company comes close to matching its long-term results, according to Wharton professor Jeremy Siegel. The same dollar invested in the S&P 500 over the same period would be worth $87 or 98% less. But what's extraordinary about this story is that this industry has been in decline for decades. Fear, disgust and hatred is good for investors. A lot of investors, understandably, want nothing to do with these companies. Some pension funds are barred from owning them. And then there's the constant threat of litigation, which has hung over the industry for decades. It adds up to millions of otherwise enterprising investors who won't touch these stocks. Low investor demand keeps these stock valuations low. Low valuations lead to high dividend yields. And high dividend yields, compounded over decades, add up to massive returns. The more hated an investment is, the higher future returns are likely to be. The same is true vice versa. This is one of the most difficult investing concepts to come to terms with, but probably the most powerful. Boring is beautiful. Companies that make the same product today they did 50 years ago are different. They don't innovate, but they don't have to. It's a boring business, but it can be beautiful for shareholders because it keeps the companies chugging along for decades, if not centuries. The ridiculously large gains from compound interest occur at long holding periods. The key to building wealth isn't necessarily high returns, but mediocre returns sustained for the longest period of time. You typically find that in boring companies that don't innovate and sell the same products today that they did 50 years ago and will likely be selling 50 years from now.